Well, apparently good news is bad news, and really, really good news is really, really bad news. Live from New York City this morning. Good morning for our audience worldwide. Yields absolutely surging. Equities taking a dive. We're down by more than 1% on the Nasdaq. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Live from New York, coming up, the jobs report delivers a major upside surprise. Detroit's Big Three bracing for a UAW update, and Exxon closing in on its biggest deal since '99. We begin with the big issue, payrolls in America.
Look at what's happening with labor.
Today's data on jobs.
Non-farm payrolls.
You do need to fold that into some of the other data we've seen.
That consumer and that labor market is something that we are very focused on.
Our economy is really being well supported by two things.
The very tight labor market.
Resilience within the labor market.
And the consumer.
Consumers are still out there spending away.
Until that stops, I think we're in fire for longer.
The Fed wants the labor market to slow.
This slowdown is coming with the economy.
Only do you see the yields start to come down once you see visible signs of economic slowdown.
We will be watching, though, the unemployment rate and labor force indicators beyond just the payrolls print.
It's all about the consumer, and it's all about the labor market.
It's all about the labour market right now. With us to break it down, Mohammed Al-Erin of Queen's College, Cambridge. Mohammed, let's get straight to it. Your thoughts on that one from 31 minutes ago?
I had three reactions, John, two of which you covered in your introduction. One, this is good news for the economy right now. The fact that we can deliver over 400,000 jobs, if you include revisions, without earnings pressure is good news. It is, secondly, bad news for markets and for the Fed. The Fed is not going to welcome this report, which leads to my third issue, which is over the long term, this may end up being bad news for the economy as well.
Well, let's break that down piece by piece and jump to the Fed piece of it. From your perspective, Mohammed, as you look at the move in Treasuries this morning, and let's break it down together, two-year yield higher by more than 10 basis points, 10-year up another 15 basis points, and briefly at cycle highs, fresh cycle highs just moments ago. Is that the market doing the Fed's work for it, or are you expecting more from the Fed because of these numbers?
So if this were not a data-dependent Fed, and how often have we heard this, we are data-dependent, which is always strange to me, because you are acting with tools that have an impact with a lag. But given how often they've said this is a data-dependent Fed, yes, it puts back on the table a hike for the 1st of November, which means that market now are not just having to internalize high for long, but higher for longer. And that is the problem. When you fall behind right at the beginning of an inflation cycle, you pay the price when you get to the last mile. And that's what we're doing right now.
A three-part story for you then, Mohammed. First of all, the data's good for the economy. Secondly, it's bad for the market, but ultimately that could be bad for the economy further down the road. You wrote for the FT earlier this week, the US may no longer avoid recession. How do these numbers play into a call like that?
Unfortunately, they are consistent with that call. Look, John, this is an economy that got used to ridiculously low interest rates and got used to liquidity injection. The change in the regime is happening really fast. So something is likely to break, probably in the financial markets, but that will have spillback into the economy. Then there's a second issue, which is just as important. This economy has to deal with a whole host of other things, the most important of which being that it is the supply side that's a problem, not the demand side. And unfortunately, that realization is not fully yet comprehended by the policymakers and by the markets.
Jason Furman weighing in this morning and on Twitter. I'll share that view with you all. First reaction to jobs numbers, shock. Second reaction, nervousness. Further reflection, this could be quite good. Went on to say 336,000 jobs, participation's high, wage growth's moderated. We could be in the middle of a sustainable increase in labour supply. That's the hope and the dream, Mohammed. Is that the reality?
So Jason is right. I mean, if we didn't have the financial markets and if we didn't have a data-dependent Fed, then Jason would be absolutely right. The concern is the spillback from the financial markets and policy onto the economy. This on its own is really good news and will be welcomed by the White House. It will not be welcomed by the Fed.
It's not welcomed by the market right now. Equity futures down by 0.9% on the S&P. The jobs data looking really strong. I think we've all forgotten about that ADP report a little bit earlier this week. Yields up at the front end, up at the long end. On a 30-year, earlier this week, briefly through 5%. Back through it right now. The 30-year, 5.02%. Yields higher by 13 basis points and change. Mike McKee breaking down this jobs report. Mike McKee, I think you and I both just said wow when that one dropped.
Absolutely. I think the word that you'd use over in London is gobsmacked by this number. It really was a shocker. Nobody had anything close to this in the Bloomberg Economic Survey, and nor did the people on Wall Street trading desks. 336,000 jobs created, and then add in 119,000 revisions higher to July and August. The unemployment rate stays the same at 3.8%. Nothing really remarkable there. More people got jobs than lost jobs, but the labor market only grew by 90,000 during the month, unlike 700,000 the month before. The jobs numbers, the best part of it here is the average hourly earnings, just 0.2%, up 4.2% on the year. And the interesting thing about that is that this was a longer period of time, which is why some analysts thought we would get a high compensation number, because more people would have gotten jobs during that period at higher rates. We didn't see that. Service industries, 234,000 jobs. And the interesting thing there, wages up only 1.7%. Leisure and hospitality continues its run, 96,000. Public education, this could be a seasonal adjustment problem with August numbers, up 40,000. And I threw trucking in there because we lost 37,000 jobs last month because of the Yellow company going out of business. 9,000 of them absorbed back. So a turnaround there that helps boost the numbers overall. Here's the good news for the Fed. The payrolls numbers go up so dramatically, and yet we see a decline in average hourly earnings on a year-over-year basis. To my mind, guys, this makes next Thursday's CPI report even more important, because I'm not sure the Fed will look at this badly if the CPI continues to decline, because the Fed doesn't necessarily want to see employment go bad. They just want inflation to come down.
So, Mike, is it possible to bring inflation down with such a hot labor market?
It's possible, depending on whether we see people spend more than they normally do. Spending's come down to about the point we were at pre-pandemic. The savings is gone. People are spending out of their salaries. So it is possible you can get back into alignment. And we've seen supply come into better balance. Doesn't look like there's any kind of wage price spiral, though. So, yeah, it's possible. That's what the Fed's not going to know.
Keep digging, Mike. Keep digging. We're trying to work through this one. Mike McKee there breaking down the jobs report. Let's keep digging into this bond market as well. Treasury curve steepening, selling off at the long end. So yields are higher on a 10-year, on a 30-year relative to the price move today on a 2-year. The 2-year's up by 8 basis points. The 30-year is up by more than 12. So the curve is steeper. 2's out to 10s by about 5, 2's out to 30 by about 5 basis points also. Mohammed, let's talk about the character of that steepness. We thought if we were going to get a steepening of this yield curve, it would be driven by the front end. The jargon, of course, is the bull steepener. You get a rally at the front end, yields drop because you're pricing in a rate cutting cycle from the Fed, who has to confront a slowdown in the economy. We're not seeing that. In your experience, Mohammed, how rare is it to see a prolonged sell-off at the long end of the curve, to see the steepness come from a so-called bear steepener?
You had Priya Mishra on earlier today, and she summed it up very well. This is very unusual. But there's a reason why this is so unusual, and that's because the characterization of the economy has changed in my mind. What we're seeing here, John, is just a massive reaction to not rates going higher. That was last year. That was the understanding last year. Rates are going higher, but if you remember, there was a hope that was priced in that the Fed would be cutting pretty soon. This year is about high rates staying there for longer. And that is a fundamental change of how you think about the yield curve, and that's what we're seeing playing out in the markets.
One phrase I've heard, Mohammed, a few times this week is buyer's strike. Let's put some meat on those bones. Is this the investor basically saying, I'm not going out along the curve so long as it is inverted to take on a 10-year maturity for less yield when I'm seeing an expansion in economic data like that?
Yeah, and I also think, John, it's simply, I'm not going to catch a falling knife. That's what it is. I am going to wait on the sideline, see how things settle down. These moves are historic. They're absolutely historic. We're going to look back on this as, did we really move by that much every single day? And then the second thing to remember is that we don't know what the retail sector is going to do. There are very big losses right now in bond funds that are going to have to be somehow gotten used to. And then the last thing, John, I would say is, a lot of people are saying the markets have functioned well. Yes, they have functioned well, but the extent of the moves suggests that there is something else going on. And people are asking the question right now, where is the pain? And today, the pain is going to be increased. So there's going to be a lot of people interested in seeing how the technicals evolve from here.
You and I have got a lot to talk about through the next hour. I'm pleased to say Mohammed's going to be sticking with us to break down some of the stuff we need to unpack, particularly at the end there. The prospect of things breaking, maybe even forced selling, with all that unrealised losses sitting on some books somewhere out there in the Treasury market. Equities lower by about 0.8% on the S&P, with some movers going into the open. Here's Abby.
John, let's keep it macro and on this hot jobs report and yield steepening in the way that you all were talking about and the re-steepening of the yield curve. Let's take a look at technology because, of course, as yields shoot higher, this makes valuation look less attractive. Microsoft down 1%, Tesla down 2.7%. Also weighing on Tesla, perhaps, are some of the Model 3 and Y price cuts here in the U.S. And then the banks not really getting a bid from yields going higher or the re-steepening in the yield curve. You can see J.P. Morgan Chase, it's down 0.6% right now, John. The S&P 500 E-mini futures heading to a fifth down week in a row, the longest losing streak since May of 2022. So this idea of longer or higher for longer, it is certainly weighing on stocks.
Abby, there are some big moves out there, that's for sure. Abby's going to break them down for you in about 20 minutes' time around the opening bell. Coming up, much more on a monster upside surprise.
The incredible strength of the labor market continuing to be there. But the silver lining is that we didn't see a lot of kick up in wages. So I'd want to get into that in a little bit more detail, because that's really ultimately what is going to affect costs and what's going to drive inflation. Maybe I was being too harsh in saying there'd be a hardish landing. Maybe we've got something that's perfect Goldilocks.
Perfect Goldilocks? We'll question that next. The conversation continues with Mohammed Al-Erin, Victoria Fernandez and PGIM's Michael Collins.
The president went to Michigan very recently, just last week, a week ago, actually, to show his support and to stand in solidarity with union workers. And that is, he did that because he believes that unions have the collective bargaining rights to ask for fair pay and fair benefits. He believes, as it relates to UAW, record profits should lead to a record contract. The president is always going to be proud of being the most pro-union president ever.
The labour market in America at the epicenter of conversations this morning. The White House pushing the president's pro-union agenda as the UAW strike continues. And if a deal isn't reached soon, the impact could be wide-ranging. A full strike involving all 150,000 UAW members could impact 760,000 jobs and show up in October's payroll report. September payrolls coming in much hotter than expected. Kelly Lyons joins us now for more. Hey, Kaylee.
Hey, John, way hotter than expected. And that 336,000 print on payrolls for the month of September is certainly something that here in Washington, the Biden administration is going to be touting as a sign that Bidenomics is working. We'll hear more from President Biden later on this morning at 11:30 a.m. Eastern time. The difficulty, though, for President Biden is, on the one hand, yes, he wants and frankly needs a strong economy and labor market as he campaigns for re-election in 2024. But he also wants to be the most pro-union president in history, as he is often dubbed himself. And that is where potentially you could see things running into conflict. Our team here at Bloomberg Economics says a prolonged UAW strike, because of its secondary effects, could mean that every striking worker leads to the loss of 5 jobs in total. And when you add it all up, that is where the number of north of 700,000 layoffs comes from in the worst case scenario. And our team says if this strike lasts for 2 months, you could see 0.4 percentage point knocked off of fourth quarter GDP. We'll, of course, get more information as to whether or not the strike is expanding later today, 2 p.m. Eastern time, another Facebook Live from Sean Fain. And we know leading up to today's announcement, we have seen GM making a 6th contract offer to the UAW. Reportedly, it is a sign of progress, but not necessarily enough to stop the strike because it still comes up short of the latest offers from Stellantis and Ford. Ford, of course, made its 7th offer to the union this week, including pay raises of more than 20%, some sweetened contributions to the 401k as well. We'll see if any of it is enough to spare any of the big three an escalation later today. John.
The longer this labour market stays hot, the more leverage they get, that's for sure. Kayleigh, thank you for the update. Joining us now to weigh in, PGIM's Mike Collins, Crossmark's Victoria Fernandez, still with us, Mohammed Al-Erin. Victoria, first to you. Your reaction, please, to a blowout headline number.
Yeah, Jonathan, it was a much higher number than we were expecting. We did think that we were going to continue to see growth in the job market. We know that we're not at the point where we're going to get a negative number. What we were really focusing on was average hourly earnings. You're just talking about all of the wage strikes, how that's going to feed into any kind of wage spiral that we see and what that means for the CPI report coming next week. We saw that go to around a 4.2% year over year. You combine that with a participation rate that didn't seem to go much higher, then I think that's where the elements are going to lie on how strong exactly is this labor market. You know, we had the JOLTS report earlier this week, and the one thing we have to look at is the quits rate is actually slowing. And I think some of that is because the wage difference that a lot of people were getting when they were changing jobs was up around 16, 17% higher. That's come down to single digits. So I think you're starting to see people level off a little bit in the rate of change for their jobs. We still obviously have a very strong labor market out there, and I think that's going to be difficult for the Federal Reserve. I know higher rates. Mary Daly was saying that that's like a rate hike, that takes the place of a rate hike. But when you have numbers this strong, and if we get a CPI number that does not show the level of disinflation that people are looking for, I think the Fed is back in the hot seat of needing to hike another 25 basis points.
Mike Collins, Francis Donald of Manulife this morning saying this: a soft landing negates the probability of a soft landing. A soft landing is not bullish for any asset class. Mike, what are your thoughts this morning?
Yeah, Jonathan, we've certainly been in, I don't know if I'd call it the soft landing camp, but, you know, a resilient economy camp, right? And you've seen it in so many ways, and this is certainly reflecting that. And we've also been in this, you know, higher for longer rate view. But I have to admit, I really didn't expect the extent of the job growth to continue. And maybe this is one number, maybe it's a flash in the pan, but the real surprise to me in the markets, and I think where maybe the markets are mispricing, is the extrapolation of the Fed's higher for longer narrative that has happened has reached pretty extreme levels, right? I mean, the markets are now pricing in. So bond geeks look at five-year interest rates, meaning what's priced into the market, what the market's crystal ball is telling us for the next 10 years. And right now, the markets are pricing in a Fed funds rate that only goes down to about 4.4% and stays there forever. And a 5-year treasury that only goes down to 4.80, meaning it barely moves from here and stays there for 10 years, right? And it's really hard for someone who's been in the bond market this long to really grasp the idea of a funds rate that's in the fours, the mid fours, for 10 years, right? At some point in the next 10 years, it's probably going to be lower than that. So that's really what's happened in the bond market, and it's really shocking.
So, Mike, I'm trying to understand where you're going with this. There's two possibilities. One is that the market simply is wrong, or two is that it's hard to reconcile the market's interpretation of higher for longer with your hope for soft landing. So which is it?
Yeah, the markets, these long-term forwards, Mohammed, as you know, they are wrong all the time, right? They overshoot, and investor behavior drives that, right? And what you've been talking about, Jonathan, this morning is the investor psychology out there, what they're thinking, and they're terrified of stepping in front of this rate sell-off. So they're all piling into cash. I've been speaking with a lot of investors over the last few weeks, and they are really hunkering down in the front end of the yield curve, holding on to cash. They've kind of given up on owning these longer term bonds. And people obviously are selling this morning. People are shorting treasuries through futures. So you do get these big kind of extreme moves, Mohammed, typically, in the deep parts of the recession and at the peaks in growth and at the peaks in Fed funds rate hike expectations. And it feels like we're kind of, bouncing around one of those peak periods and one of those extreme periods in terms of the permanence of what's priced into the market.
So, Victoria, if this migration to cash from both public equity markets and public fixed income markets continues, how does it impact your outlook?
Well, obviously, we want to see people be invested in the market fully. And even though we have had a negative outlook all year, I mean, we have been in that camp that said the soft landing probably wasn't going to be our outcome. We've actually been investing on some of the parts of the longer end of the curve for our clients. We don't want to just sit completely in cash or completely in a 3-month or a 6-month T-bill and have reinvestment risk coming. So the fear would be that if everyone is sitting in cash and they're waiting to try to time the market, they're either going to miss that, which is probably what's going to happen, or you're going to have a huge influx at one time and cause a lot of volatility. We would suggest, and what we're doing with our clients on the fixed income side, is you really need to barbell that. You need to have some exposure to cash or cash equivalents or short-term treasuries. But look, we're at a 490 on the 10-year treasury. I'm not sure how much higher many people anticipate it will go. Technicals tell you maybe around a 510 or a 520. If you're buying individual bonds, you're buying at a discount right now, collecting your coupon, and you can hold that bond till maturity and receive par for it. So I think there's something to locking in these higher rates on the longer end while still having some flexibility and some liquidity on the short end, especially as we see liquidity coming out of the market. In the reverse repo market, we're seeing it with foreign treasury buyers going away. I think there's some liquidity components that we need to address as well.
Victoria, we'll talk about that. Mike Collins, Victoria Mohammed sticking with us. Your 10-year this morning, a cycle high briefly, 488, right now 482. Coming up the morning calls and later, Acting Labour Secretary Julie Su with the latest on the jobs report. 4 minutes from the opening bell. Equities trying to recover here. Let's get you some morning calls. Your first one from Oppenheimer, downgrading O'Reilly to market perform, expecting limited upside as pandemic-related tailwinds continue fading. Bernstein initiating coverage on Netflix with a market perform rating, seeing a mixed outlook due to mounting competition and slowing growth. And finally, Jefferies upgrading Elf Beauty to buy, seeing an attractive buying opportunity after recent declines. Coming up, the opening bell with more from Mohammed Al-Erin and Victoria Fernandez alongside Michael Collins, and later Acting Labour Secretary Julie Su weighing in on the latest payrolls report. Your opening bell just around the corner. 24 seconds away from the opening bell this morning. Good morning to you all. We pull back on the S&P off session lows. Just on the Nasdaq, we're down by 0.8%. On the S&P 500, down by 0.6. 5 is not the magic number. We're heading towards a 5th week of losses on the S&P. Unless that changes. There's your opening bell. Switch to the board and get to the bond market. Heading towards a 5th week of yields climbing on a 10-year maturity. Your 10-year this morning higher by 12 basis points to 484. Yields up, dollar stronger, euro lower, 105.12. The euro poised for a 12th consecutive week of euro weakness against dollar strength. The dollar absolutely dominant in G10. That currency pair pulls back by a third of 1%. And crude, look out below all week, heading towards the biggest weekly loss potentially going all the way back to March. Crude right now positive by 0.6%, 82.83. About 30 seconds into the session, this looks better than it did about an hour ago. On the S&P, we're down about 0.5%. On the Nasdaq, down by about 0.7. One stock to watch at the open is Exxon, the energy giant in talks to acquire Pioneer Natural Resources, nearing its largest takeover since 1999. Citi saying the following: the logic of consolidation in the highly fragmented Permian shale remains compelling, with significant gains to be achieved. Abby has more. Hey, Abby.
Hey, John. And yes, this is a big one. So sources are saying that ExxonMobil is very close in advanced talks to acquire Pioneer Natural Resources. It could value Pioneer at $60 billion. Yesterday, Pioneer had been worth $50 billion. They, of course, are one of the premier producers from the Permian Basin, which is basically runs from parts of Texas and New Mexico. It's one of the most lucrative parts of the oil patch in the U.S. because it's much more easy to extract the oil. So what this would give Exxon essentially is, rather than buying a company where they would potentially have to develop unproven acreage, almost like a faucet where they can turn it on and off. So when oil is lower and volatile, and it's been weighing a little bit, ExxonMobil into today had been down about 1%, and Pioneer into today down about 5% on the oil volatility, plus concerns that there could be a global slowdown and that would weigh on oil. But if there was a resurgence, they basically just have to bring out this oil. It's not quite as simple as that, but that's one way to look at it. Now, sources are saying that this deal could close in coming days, but it might not be super easy, John, because there could be some solid political and regulatory issues, scrutiny, given the fact that earlier this year in February, the White House did accuse Exxon of achieving what are called bumper profits at the expense of consumers. Stay tuned. But right now, we do have Pioneer up about 8%, Exxon down 3%, suggesting that many do think that the deal could actually go through.
Stay tuned. Abby, thanks for that. Let's turn to the autos. GM presenting its 6th contract offer to the UAW, writing in an email that they're ready and willing to negotiate in good faith 24/7 to reach an agreement. This coming as Union President Shawn Fain prepares to deliver an update on social media at 2 p.m. this afternoon. Simone Foxman on top of this story. Hey, Simone.
Hey, John. Yeah, all eyes are on that announcement, which will be Facebook Live, YouTube, etc. in this day 22 of the United Auto Workers strike. We could hear plans to expand the strike today. Right now, 25,000 United Auto Workers are striking of the 145,000 total population. And so far, the strikes haven't impacted the plants that produce the full-size pickup trucks, the large SUVs that are the most profitable for these companies. So we're very much focused on where we see those potential strikes expand, because they could have more of a hit than we've currently seen on their bottom line. And we'll also be looking for whether or not the union is going to reward progress on some of the talks, including perhaps with GM, where it does seem both sides have made some progress a little bit on retirement benefits, even though GM very much focusing on strengthening 401ks. However, despite that announcement from GM that there was this offer submitted, we saw shares close at their lowest since September 2020. Ford has also been under pressure, really lowest since August. Stellantis is holding up better a little bit because of its global operations, and shares of all those companies are down, or Stellantis unchanged today.
Simone, thank you. More on this story with the Acting Labour Secretary, Julie Su. We'll cover this in about 10 minutes' time. Let's check out shares of Tesla right now. Tesla cutting prices on its top-selling models in the US again after Q3 deliveries fell short of estimates. CEO Elon Musk taking to X to challenge his critics, writing this: "Sometimes they question if I should even run Tesla. My response is simply, watch other CEO. Would you prefer?" Isabel Lee has more. Hey, Isabel.
Hey, John. Lots of markdowns across the board. The company slashing the starting price of its base Model 3 by $1,250. It's slashing the long-range version of the sedan by the same amount. And the Tesla also shaved some $2,000 off the price of the performance version of the Model 3, as well as the performance versions of the Model Y sports utility vehicle. So what do these discounts mean? Two things. It will dampen the company's profit margins, but it will help stoke demand. And we have the CEO, Elon Musk, downplaying the trend so far. He said that, the company could sacrifice earnings up front, but it could make it up by software upgrades. Tesla shares are now dropping by some 2.5%. The stock has more than doubled this year, John. It's up by 111%. Tesla has delivered some 435 vehicles in the last 3 months, but it's still short some 20,000 of what analysts were expecting, John.
What a move on that name this year. Isabel, thank you. 254 in early trading. Let's finish on consumers. Levi's wholesale concerns persist after reporting third-quarter results. The CFO saying this: "Given the ongoing uncertainty in the macro environment, we're taking a cautious approach to our outlook for the fourth quarter." Katie, that stock down 3%.
Yeah, it is a down day for denim. Quarterly revenue came in light, and that led the company to take a, quote, more cautious approach to its projections. Levi now sees EPS at the lower end of its previously stated range, while scaling back its revenue outlook as well. Now, if you take a look at the last few quarters, Levi actually either met or beat its estimates, which makes, of course, this latest round of earnings even bleaker. And of course, they're the first major U.S. apparel retailer to report, and their results are closely watched for that reason. Levi CEO told Bloomberg News in an interview that, quote, middle-income consumers and below are definitely being impacted, especially here in Europe, but that's also true in parts of Europe as well. Now, the sell side not too impressed. While the direct-to-consumer business was a bright spot, it was the wholesale business that remains a concern in some of the reports coming out this morning. And you can see that in the shares. Levi currently down about 2.7%.
Katie, thank you for the update. Allow me to give you the update for the broader market. If you're just joining us, where have you been? You missed it all in the last hour. The jobs report, a blowout number, 336,000. The estimate, 170K. The previous number, 187. The move you might expect. About 16 or 17 minutes in, or rather 6 or 7 minutes in, equities are down by about 0.5% on the S&P. The Nasdaq's down about 0.5%. Major moves in this bond market. Yields up another 12 basis points to about 4.84 on a 10-year, on a 2-year, back to 5.1%. On a 30-year, we're back at 5%. We're back now with PGIM's Mike Collins, Crossmark's Victoria Fernandez, Mohammed Al-Arian. Mohammed, I want to come straight to you and ask you about the financials, the banks. Typically, we talk about good data, higher yields, good for financials. That's not happening. Why not?
I think the markets are concerned about two things. One is the impact of higher NIMs, potentially. Higher net interest margins are being offset by deposit outflows out of banks into money market funds. The second issue, which is of more concern to the market, is that there's a worry that if interest rate risk continues to be in play like this, it will translate into credit risk and liquidity risk. And I think that is what's being captured by yet more pressure on the financials.
Victoria, is that something you're worried about?
Yeah, I mean, I mentioned a few minutes ago that we were concerned about the liquidity issues that we're seeing in the market, and I think that's part of what you are seeing in the financials, along with the fact that you're seeing like Citi say that charges on credit cards was actually down over the last few weeks. So the consumer is getting hit a little bit harder. That has to be concerns growing then around lending, around delinquencies on credit cards. All of that feeds in to what these financials are doing. And when you tighten those financial conditions and when you squeeze the liquidity that's in the market, financials are not going to do well, even with the re-steepening of the curve. I do think, however, we'll see financials start to come back because their balance sheets are strong. So even with all the macro data that's going on, the balance sheets themselves should be able to hold through the volatility. So I think you want some exposure to them for longer term holdings in your portfolio.
Mike Collins, I want to talk about these unrealized losses in this Treasury market. The price destruction in Treasuries, particularly at the long end, since we peaked back in spring 2020, has been absolutely phenomenal. The team here at Bloomberg broke down the numbers earlier in the week, and at the time that story was published, the numbers looked like this. Bonds maturing in 10 years or more, they've dropped 46% since peaking in March 2020. 30-year bonds, even worse, tumbling 53%. These are monster moves, Mike. They're getting even worse this morning. Mike Collins, who owns that? Where's that pain right now? Where's it sitting?
Yeah, Jonathan, that's exactly where I wanted to go. And that's kind of the third leg of Mohammed's stool that could hit not only financials, but broadly the whole economy, right? And who owns those bonds? Fortunately, you know, the Treasury or the Fed owns about 8 trillion of them, right? So that actually does cushion the blow to the private sector. But insurance companies own them, pension plans own them, individuals own them. And it's not just bonds being marked down, Jonathan. It's all asset prices. I just came from a real estate conference, and people are really worried about the potential for a lot of forced selling. A lot of people bought real estate at high prices over the last couple of years, and those marks are moving down, and they still have a long way to go down from where they are today. And the financing cost, if you didn't lock in your rate, is going in the opposite direction. So a lot of these are now underwater, right? So it's really across the whole economy. You see it in stock prices every day, but it's really the slow-moving prices. It's the private debt. It's the commercial real estate. That's another shoe that hasn't dropped yet.
So, Mike, I want to push you a little bit more on this, if I may. Because it's not just domestic, it's global. People are also worried about the spillback from the Japanese reaction. So is this a slow-moving process that the market can accommodate and the economy can accommodate? Or is this something we should be worrying about tipping points?
You know, I think it is a slow-moving process. Our base case, Mohammed, is that there isn't as much leverage in the system generally. Like a lot of this real estate hasn't been overbuilt. It hasn't been levered. Certainly the housing market is not levered at all. The banking system is, as Victoria pointed out, is not a levered system anymore, right? So that's really good. But as the realization of these lower asset prices, and you do get liquidity events and flows where people have to, realize those losses at some point. And so maybe it takes quarters or even years to get realized, not days and weeks, but that is something that does nag at us over the intermediate term and make us certainly more cautious on the global credit markets in general.
Mike, we've heard a lot of Wall Street phrases, cliches through the week, catching falling knives, buyer strikes, all of that bad stuff. Mike, your colleague, Dalip Singh, talked about the loss of predictable demand in the Treasury market, China, the Federal Reserve. Mike, that's not coming back potentially. How does that change things? That change of character in the sources of demand, what does that mean for this Treasury market, this Treasury curve?
Yeah, I mean, part of that, believe it or not, Jonathan, again, this is kind of wonky stuff. Some of that is priced in. If you look at long-term Treasury yields versus long-term expectations of the funds rate or other derivatives on that interest rate, it's about a 70 basis point yield premium that the Treasury is actually paying every time they go to the auction block to issue Treasury. So there is a supply premium already built in. You could call it a credit premium in some cases on the Treasury market, built in already, and that's one of the reasons that yields are at these higher levels. And whether that persists or not is anybody's guess. But it's a little encouraging that a lot of that is priced in.
Mike Collins, thank you. Mike Collins alongside Victoria Fernandez, together with Mohammed Al-Aaron. I'm pleased to say Mohammed's going to stick with us. Stocks pulling back by about 0.6% on the S&P 500. Up next, the September payrolls report coming in hot.
This is a much stronger labor market. Clearly, that's what we see in the report today across the board.
Acting Labour Secretary Julie Su up next. Live from New York City on Bloomberg TV and on Bloomberg Radio, I'm Jonathan Ferro. Joining us now from Washington is Julie Su, the acting U.S. Secretary of Labour. Julie Su, wonderful to catch up with you. A hot labour market report at a time where the unions seem to have a lot of leverage, so let's go straight there. What's your latest read on the UAW negotiations?
Well, the parties are at the table. They're continuing to negotiate. The president has made very clear, something I believe in too, that when there are record corporate profits, there should be record contracts for working people, and that's what workers are fighting for. So the negotiations continue, and I believe that the parties will get there.
Are you getting access to both parties to help negotiate a settlement?
Yeah, we're talking to both parties. I mean, again, the collective bargaining process is about the parties themselves coming together, working through their issues, finding common ground and win-win solutions. We support that in every way that we can, and we are continuing to talk to the parties in that particular situation.
What have you heard recently about current demands from UAW? We understand that wage demands have come down from 40 closer to 30. Is that your read on things?
I mean, and the negotiation is always about movement on both sides. At this point, I think it's always hard to know exactly where something will land. I think as long as they're talking to each other, that is positive, and that is what is happening.
You're sensing the gap is closing, the spread has narrowed.
I'll say it this way, I've seen this a lot. I think that the parties always seem like they're far apart until they're not. So that always requires movement. And I think the continued engagement is a positive thing. And it's part of the reflection of President Biden and this administration's commitment to workers getting their fair share in an economy that is doing really well.
We also have healthcare strikes as well. I understand you've met leadership from both sides. Julie, how different is that particular strike? What do you think is going on there?
I mean, every strike has its unique issues, right? The industries are different, the specific demands are different, but I think the bottom line is that we are seeing a resurgence in worker power, in support for unions in the economy, and for working people demanding their fair share, saying, enough of the disparities between what frontline workers make and what CEOs make, making sure that there is an opportunity for workers to improve their working conditions and live stable lives this is not just an accident in a Biden-Harris administration. It is very much a deliberate part of how we think a strong economy and a strong country works.
Madam Secretary, as you rightly said, we are seeing a shift back in bargaining power towards labor after decades where it went the other way. That's being reflected in a spike higher in number of days of strikes throughout the economy. Should we expect that number to go even higher?
I think it also reflects really record contract results, right? So we've seen from the ports on the West Coast to the Teamsters and UPS, really results that demonstrate workers getting more in wages, ending forced overtime, dealing with other specific issues within certain industries, or automation and the like, addressing conditions like heat and other kinds of health and safety issues. So I think those are the big results. And some of them we're talking about, we don't talk about them as much, but there are, graduate workers who have gone on strike for brief periods and gotten contracts that they want. So I don't know what the average number of days is, but I do know that workers coming to the table, being able to have the right to demand their fair share is something that has been positive for workers and is very much part of the strong economy that we've been talking about, and the jobs report reflects this.
And yet we have not seen that in the numbers on earnings. So is it just a lag effect? Are we going to see it going forward? Or is there something else going on in the economy that's offsetting those gains that you talked about for workers?
Yeah, so earnings are up a bit. We definitely especially see that among lower wage workers, which is part of this idea that, the president has said, we're going to build an economy that leaves no one behind. That starts by looking at who's been left behind in the past. And to the extent that those lower wage workers are seeing average gains that are growing and also that are higher than inflation, means that workers have more money in their pockets, more to spend in their local economies. That's also partly fueling the other effects of the jobs report, which is, more job growth in leisure and hospitality, for example. All of these taken together, along with the historically low unemployment rate, still under 4% for over a year and a half, the longest stretch of the 1960s, are all signs that this economy is a place that, is doing well because of good economic policies and workers having a seat at the table.
Well, let's talk about those policies. There is something really peculiar going on at the moment. If you think about what's happening at the picket line, they have serious concerns about the EV transition and their participation in it. A transition that you are subsidising. Something really odd from my perspective, and I'd love some clarity from you on it. Why is the government offering rich people credits to buy expensive cars?
So, a couple of things. There is widespread support in the country for tax credits that will help to bring manufacturing jobs to the United States. That's part of what we're trying to do. The other is that we do have a climate crisis, right? We saw record heat across the entire country.
Oh, without a doubt.
Globe,
Can I just jump in? Without a doubt. I totally agree with you, but I just think we're conflating solving a climate crisis with driving really heavy SUVs that run on electricity. Are those two things part of the same story? Because I don't get it. If I'm driving an electrified F-150, am I really saving the planet?
Right. Well, so we could probably have a conversation about personal choices relating to cars. I do think as a policy matter, the more that we can invest in industries, in manufacturing, including in transportation, that transitions us to a place where we're not continue to pollute the planet, right? We have a method by which we can both bring down emissions and also create good jobs. And the president has always said that solving our climate crisis, when he looks at that, it's also about creating good jobs and good union jobs in communities that need them the most. And we are really focused on making sure that that transition does not leave workers behind, and that what's good for the climate can be good for workers as well.
Julie, appreciate the update. Julie Su, Acting US Secretary of Labour. Equities down, your trading diary up next. Mohamed El-Erian, you get a final word this morning. What a morning so far.
It is a morning, John, and it's one that should remind us, whether it's the job reports, the UAW, that it is about the supply side. We should get used to the fact that the supply side is a constraint, and that means difficult decisions across the board. And unless we make these difficult decisions quickly, including at the Fed, we may mishandle this last mile in the fight against inflation.
Mohamed, thank you, sir. Fantastic to catch up this morning. Live from New York, this is Bloomberg.